In a world of relentless disruption and boundless innovation, there is one balance we cannot afford to break. As machines shape the future, nature remains irreplaceable. Join us at the Black Swan Summit to explore how disruptive technologies are transforming the world, while safeguarding its delicate balance. Or are they?
Place to look into the future than Singapore, a place where fintech flourishes and where this festival brings the unlimited energy of fintech enthusiasts.
Trust, those are two key benefits, right? Having additional trust on the tokenized asset, you get more transparency. So when it comes to, say, ESG assets, very, very important. You have a carbon credit. If you don't know what it represents, are the trees even still there? The ability to verify the information behind the asset is very, very important. And data integrity use cases are essentially made for blockchain because you can see in real time what's happening. Obviously, there is the need to reconcile the real world asset with the digital twin. That's where one of the challenges lies. So for carbon credit, for example, we have an open source toolkit called Guardian OS where you plug in your policy, you plug in your IoT data feed so that you can actually see in real time, whether it's a soil analysis or satellite imaging, you have access to that information. But you could also have carbon credits that are not made in that way, and they could be tokenized, but not with that level of granularity. Then they will actually fetch a lower price in the market, right? So there is this transparency actually comes with financial benefits because a high quality carbon credit actually will have a higher price than a low quality one. So those are things that are very tangible in terms of benefits. You also have fractionalization, better liquidity. So that unlocks certain use cases. You can have more diversification of a portfolio if you can buy a smaller piece of like real estate, for example. So it is a step beyond what TradFi systems can provide. You're not reliant on a siloed database at one financial institution anymore, right? You can actually break those silos and let the information and the value flow.
Okay, so I hear that it's not a traditional finance approach that the data sits in one financial institution, but it's spread across a network of computers around the world.
In certain cases, it is,
yeah. And that provides the security and transparency, so that we can say that token actually represents something and everybody can verify it.
Correct.
And I think what tricky is the question you mentioned, how do we actually verify, and maybe tell a little anecdote to our audience. I designed one of the first units here in West Australia on blockchain and DLT business and tokenization. And as an experiment, we invited guests, and I used to give them a bottle of wine as a thank you token. And I actually turned that bottle of wine into a token. I tokenized the bottle of wine and sent that token to one of the engineers to collect his bottle of wine. He never collected it, but the bottle of wine was in my cupboard for a long time. But he had the token, and if he did it himself or passed that token to someone else, they could come and claim that bottle of wine. By accident, 1 year later, I opened the bottle of wine and drank it. So yes, the person has the token, but effectively they cannot do anything with that. So how do we overcome that question, that challenge, or the disconnection that you mentioned between the digital world and the real world? How do
guess there's two ways to do it. The one way is, especially if you're looking at a physical asset like wine, like you can actually put a sensor on the cap, and if your wine has to be valuable enough that you want to do that. But so you can't really do that at scale, except for like really vintage, high value logs. So you could do that from an IoT perspective. And IoT blockchain are really good.
Internet of Things, so sensors.
Exactly, sensors. The other option for more intangible assets are to have the asset to be born on chain, to be digitally native, so that there is no physical security to like settle in the background, for example, so that your like house title is already digitally native. Then if you own the title token, then that means you own the house. So those are, either you take care of the disconnect between reality, the physical and the digital world, by adding data streams and verifiable data, or you remove that connection by just making everything digital.
Okay, we'll come back when we talk about real estate in a second, but I would like to know we move to Eli, because tokenization, what does it look like from a legal perspective?
So let me zoom out first. In Australia, securities law is governed by the Corporations Act. The Corporations Act defines financial products in a very broad way. It's got a broad definition, and then it goes to specific things that are included, like shares, and specific things that are excluded, like loyalty programs, like that. But the general definition is still very, very broad, so it ends up capturing many things that in other jurisdictions are not captured as financial products, are captured as financial products. That means that anyone who deals with it, anyone that has a market dealing with it, anyone who provides custody services relating to that has to be regulated, has to have an Australian Financial Services license that gives them authority to deal with it in a certain manner and comply with it. Now, when it comes to crypto, we don't have a bespoke regulation for crypto. What we have to do is we retrofit crypto into the current financial product system.
You're talking about Australia, or
Australia, this is Australia, right? So therefore, if we're looking at something like securities law, asset will prioritize substance over form. So let's say an ICO, somebody who's raising funds for a project, even though they may say they're selling a utility token, if the funds are to be utilized in the project and they give you effectively the right of a share to the project or to its earnings, it's probably a security, right? The same way with derivatives. If you have a token that derives its value off something else, it's probably a derivative, right? And will have to be regulated as such. And another one would be non-cash payments. These are things that substitute payments. So a lot of the stable coins arrangement that we see now, like USDT, USDC, if they were here, they would actually run as an issue in Australia, there would probably be some form of non-cash payment. And finally, the one that's probably that we see most often is a managed investment scheme. And those who've been following crypto regulation in the US, this is the famous Howey test, defining investment contracts from a US perspective. And that's really looking at three things. It's looking at did I promise, it's normally a platform of making a promise saying, invest in me, right? I will manage that investment for you, generate some sort of return, and you don't have day-to-day control over that, right? That's a managed investment scheme, that's an investment contract. Either one of those arrangements triggers a financial product, and we have to have regulatory regulation for it. Now, when it comes to real-world assets, again, substance over form is what we care about. So when we're talking about real estate, if you're looking at the traditional market, you've got a house, right? Selling a house is not a financial product, right? There may be regulations around real estate agents and around property law, and all of that applies, but it's not a financial product, right? But once you have a real estate investment trust, where you're basically pooling a whole bunch of money and investing in real estate, that is a financial product. So in a similar way, when we're talking about tokenization, if there's a direct line through to the actual underlying asset, it may not be a financial product. But if there's some sort of pooling and you're managing it on behalf of investors, and they don't have control, that would probably be a managed investment scheme. The same with gold, for example. Owning a gold bar financial product, right? But once I owning a share in a minor company that's got a whole bunch of token-client reserves, certainly a share, right? And likewise, if there's some sort of scheme that has gold, but we don't actually directly, I cannot say that we own gold bar 155 and we own gold bar 6789, I cannot directly link that. There's probably some sort of managed investment scheme happening. Obviously, it's on a case-by-case basis, but that is sort of the general framework.
So I probably wouldn't get into trouble for my butterfly.
Probably not, but if you were selling that on a platform, if you were selling these tokenized shares in that borrowed line, and you controlled the borrowed line and who gets the share and who doesn't get the share, then you probably are.
What about artists who create
The same thing. I mean, if it's directly, and again that goes back to what you were saying, is it art digital or is it off-chain, right? If it's natively digital, it's very easy to actually tie in the rights to the token, and you basically manage that seamlessly. And whenever it's off-chain, when you've got this piece of art, somebody has to manage that link. Somebody has to say, well, this Rembrandt is now owned by you and you and you. And that person, if they're managing this platform in a manner that's managed investment scheme, it will be a financial product. If, in theory, if they do it in a manner where they directly link that piece of art to each individual without pooling it, without managing it on their behalf, then maybe not. But so it depends.
Both of you mentioned something beautiful, the magic word, fractionalization. So that means I don't need to go and own that piece of Rembrandt or precious gold of wine or a watch or a collectible car. We can fractionalize that with tokenization, and many people can own a fraction of that. So we can, I wouldn't do it maybe as an academic to afford anything very obvious, but I can afford a small investment of carbon products. Technically. All right, so let's talk about the green assets.
Property, for example. So you could also use it, for example, to tokenize co-living places or rent-to-own models, for example. You know, so you can use it for different kind of models. Now, why utility was important for us in this case was that Blocksquare's goal is to create liquidity in an asset that is the most illiquid asset. Only 10% of all real estate investment in the world, the $300 trillion market, is actually liquid. The rest is done. And we created the way how we transfer value within asset-backed tokens. Our biggest goal was always that we can create secondary market trades. So today I can basically buy into a property, and then if I would like to sell my property token next month, I can list it actually on the same platform and invite other community members to buy it off me.
I hear. So imagine I want to go to casino, not that I go, or to Disneyland, and I get a bunch of tokens. I swap my cash for tokens, and I can use any device in that space. Is that?
Yeah, maybe Disney
gives me access to.
Maybe Disneyland would have their own Disneyland token marketplace, and I can swap it with other Mickey Mouse fans, for example.
Ed, you have a different approach to tokenizing real estate in the United States.
Yes. Well, I look at it a little differently. We see the real estate in the largest asset class in the world, roughly $300 trillion in value. And when you look at that, about $75 trillion is actually investment in real estate. And so when you look at investments in real estate like hotels, apartment buildings, retail centers, and you look at the capital stack and what makes that up in terms of investment, about 26% of that is represents equity. And so the reason why real estate is an alternative investment is because that equity cannot be traded. So the way you can get your money back is the asset has to be sold, and then you can get your money back, unless you're going to be a private public REIT. And so I saw an opportunity when that $26 trillion being locked value could be unlocked using security tokens. And it's a big distinction. When you talk about utility tokens, that's one list of tokens. But when you're selling an investment product, you're talking about security. And so being able to securitize and also divide the equity in $26 trillion worth of value, you're now able to convert an illiquid asset into a liquid asset. It's almost like taking a building and IPOing the building like an IPO company. And so you can now issue shares to investors both in the United States or around the world who now own a fractional interest of the equity of that property, which is very tangible. So we were talking about how you directly tie it in. If you can tokenize $100 million worth of equity in a hotel, and by using the dollars as revenue, and then issue it out fractionally in $10,000 units or $1 million units to different investors, they're able to control the growth of that asset. When the asset improves in value, they have capital gains, but also the dividends are distributed from that asset. So it's purely an investment. And I think that's where we see a lot of excitement in the business, is because most people don't have access to high quality real estate. When I was selling real estate in Cushman & Wakefield, like I said, you roll next to 25 to 50 companies and things get dissipated pretty quickly. But now bringing the whole world to be able to buy those fractional shares is where I think you see a huge difference. But they are using security, so there are laws that we have to follow to make sure that in the United States the investors are accredited investors because they have wealth. But internationally, they don't have to be accredited. They just have to go through a KYC process. So that allows people in countries, even like in Australia, to be able to buy high quality assets in the United States or in other countries around the world and create their own portfolio of liquid shares of real estate, which I think has never been done before. And so this really is an opportunity where sellers who would normally own a hotel, their MO is usually buy the hotel, stabilize it, improve the value, hold it for a few years, and then sell it before the note runs out, or renew it and sell it around. But if they're able to pull their equity out of that property and still be the GP manager, they can hold that asset forever and still be able to continue to generate not only the growth of the asset, but also share the dividends that they're giving to the investors.
Okay, so the concept from here is pretty much like owning shares in a company, but they are digital.
Yes.
So why is such a big deal with that?
It's not a big deal. I mean, like I said, we
Why haven't we done it before? In the
well, there wasn't a need for it before. Back 5-10 years ago when we first started this, we started in 2018, interest rates were low. Money was everywhere. Money's plentiful. You can borrow 2-3%. You can buy something at 5% cap rate. You're positive all day long. That has changed now. And so since that has changed, liquidity is very important. Without liquidity, people can't sell to turn around and buy. People can't sell to turn around and develop. So it freezes the whole market. So now tokenizing these assets as liquidity, freezing it up, liquefying it, allows people now to get liquidity so they can continue to turn the flywheel, so to speak.
Okay, so it kind of democratizes the opportunities.
Exactly.
That's brilliant. But it sounds like you're providing opportunities for high net individuals.
Well, we started off trying to be altruistic to make sure that the lowest denominator of investor can buy into high quality real estate. That was really the purpose. But we realized that we have almost $9 billion of assets that are being tokenized, put on chain, and sell. And we realized that asking our small investors to put in 5,000, 1,000 from around the world, it takes a long time before they can get up to $2 billion, let alone $9 billion. So we had to start incorporating institutions, and now we realize institutions also want the benefit of liquidity. So when they buy a hotel and they put $20 million into one hotel, they can now take that same $20 million and diversify it into 25 different hotels and still get that. Actually, it's a better investment because it lowers their risk because diversifies their investment much more. But they also get the benefit of being able to exit when they want to exit. And that's a big deal for a lot of institutional investors. So we're going after those investors that write big checks, but we're also leaving security tokens available for the general public.
I hear that you seem to have developed a different type of market technology and DLT solving a lot of important social problems with that things. You can democratize wealth. How do you approach that from a bigger kind of perspective from Viva?
Yeah, so again, there's the financial inclusion aspect, right? So that's really important for real estate. For example, you can think of new models, the new business models that can be enabled by the technology. If you look at welfare, or you look at social housing, as you mentioned, like Australia has a 10% gap. In many countries, they have a long line until you can actually get into social housing. if you can like tokenize a rent-to-own model, for example, you know, you start earning your social housing credits, and eventually you qualify, or even for.
Well, I think most people actually never have access to investment properties. If they even can afford to buy their own home, but then actually, like it's to actually come to the level where you have the opportunity to go into investment properties, or do it for pure investment purposes, to build your passive income real estate and all that. That is for many out of reach. And not only, and I'm not only talking about like certain countries, also, I'm talking about Australia. It's, more and more people can just not get into real estate anymore. So fractional ownership in investment properties is definitely something where they can start building a really nice portfolio. Or even, you know, what we can see in the local market is a lot of interest in community living, you know, buying together a beautiful piece of land, putting cottages on there, have like beautiful areas and living spaces together. How can we tokenize that, for example? And have pure transparency and ownership rights or economic rights together in this property space. Maybe even like, you know, other areas, some of them can use and others not. So tokenization can create transparency and clarity as well between tenants by themselves, but then also social housing, for example. We have like a 10% shortage because the government funding is short, but at the same time our expenses are higher. Can we invite the community to fund that gap, for example? You know, there's different cases what you can do. What I wanted to say clearly, only because we are in Europe regulated as utility tokens. In the US, for example, we have a big marketplace operator in the US now, a developer, and they're doing security token offerings in the US, but also because of the nature of the assets they're building, they're big developers. So once you start funding pools from investors, and they're also on a $1 billion roadmap. So they're just going a different approach. So there's this approach, and then there's the other approach, which is the direct asset tokenization. That's what we do mainly at Blocksquare. For example, our asset token, our property tokens are in Europe directly shown on the land registration. So we actually created a direct connection between the token and the property ownership. So when the property settles, in the case of itself, then there isn't a token buying of the market happen in the process of settlement. Otherwise, the property cannot sell. It's similar to a mortgage on the title. So we have the on and off chain connection, which is crucial for settlement.
That's the problem with the bottom line, accidentally.
Exactly. So in real estate, actually, in nature is a very, very good asset to tokenize because it cannot be moved unrecognized, basically. Well, it can if you can sell it and tell your token holders, and you know, and nobody knows, and years later you realize, hang on, that asset is actually not existing anymore in this company. But then you can probably take it to court because it's really also regulation. But we try to do this automatically, the direct connection.
I'll also ask
Question between hyper and real innovation. I think I have to go right back to the beginning of my journey. I think we do a lot of good science. A lot of good science is done across Australia. Some of it is directed by a clinical problem, as in my case, some of it is discovery science. But I get the sense that there's a whole lot of ideas just percolating in the swamp. And what we really need is a group of people who can actually see those ideas and join the dots to create something that is of worth. Because all too often, they get put to one side and people have a pet that is theirs and they're going to push hard and hard and hard in isolation. And I think the difference between an idea that's going to work and the hype is an idea that is connected. And if you're faced with somebody who's coming and throwing this hype in the middle of the room and giving it large, ask what are the connections. What's the problem it solves? It's discussed earlier. What is the base of science behind it? What are other people around you? The network that you work in that's making this happen. They're the questions you ask, because I mean, absolutely, I believe in tissue regeneration. I am still working very hard at the coalface so that we regenerate rather than scar repair our skin and other tissues as well. And we moved that dial a long way. But I learned early on, I can't do that on my own. And in the context of innovation that is going to make a difference at the bedside, you have to take that idea, you have to shake the science down, make sure you can bottle it and deliver it reliably, transparently, etc. And then you've got to connect with people who understand the IP, the governance, the reimbursement, the marketing, the sales. Oh, and what about the development? And Marie and I went to Welshpool and found somebody who would make a moulded plastic for us in a shape that is still the shape of the resale kit now, nearly 30 years later, and still use the same dye. But we recognised we can't do that. And then we have to go to the electronics people in Go Medical in Subiaco, who were making syringe drivers, and say, can you do the electronics for this? Because we can't do that. And CSL, oh, you're the best enzyme people in Australia. We want you to work with us. We're this small little port in WA, but to get them to work with us, I ended up raising funds for a lyophilizer that was delivered to them. And they ring me and they go, oh, we've got one to you, yeah, but we've got a machine here. I said, yeah, no, that's present. Now he can't see the room. Yeah, so we've got to do it. And so they still got that. And so the difference between something that's going to change the world overnight is the network around it. Multidisciplinary, interdisciplinary, lots of heads, lots of cognitive capacity. And then money. So where do we get that?
It's a good setup for today's session.
And so when I say it took 18 years to get FDL, that's partly, probably 80-90% because of the restriction on funding, the difficulties at every step. So, but a lot of good people around, and a lot of good people helping, but it was always risky. Well, the biggest risk is that you don't take risk. Because is this as good as it gets? Is this where we're going to end up? Is this what we're going to hand over to our children, our grandkids? Because that's not what my dad handed over to me. He didn't hand over, 13 years old and a boy's going down the corner. We think ahead. We think about what could tomorrow be. How could we heal in space? I have no idea, but I know we can take the blinkers off and engage in different conversations. So we have to have these conversations because, really frankly, we have to overcome our complacence and we have to go for it. Because we've vested here, we've vested in our space and our kids and our grandkids.
But that journey was 2 points so downhill, and it took so much longer than it really should have because of that access to capital. So I'm absolutely privileged to join the guys at Pacific Channel. What a deep tech venture capital firm started in New Zealand. We're now 4 funds in. We just launched our Australian fund, and we're looking to grab that sort of technology that is solving these amazing problems of medtech, health tech, ag tech. But the funding is so hard to that. We've got an ecosystem here in Western Australia that invests in risky assets. And venture capital should be part of that portfolio. We invest in money, right? We've got the whole capital stack in there. You can be a prospector, you can be one of the biggest companies in the world. If you go to Silicon Valley, you've got that in tech. You've got the uni students and the professors and the academics working on it, like we have here. But you can also be the biggest company in the world. And that end-to-end capital stack should be our goal. We are 2% of Australia's venture capital, which is 1% of global venture capital. Just pause on that for a moment. So what do we do? What do? We bootstrap. We go to our friends and family. There's a really big problem, right? As venture capitalists, we know that 7 out of 10, depending on how good we are, we might be a good picker, we might do better than that. But failure is part of the game.
Can you afford to fail with your mother-in-law's superannuation? Or your best mate going out, sporting club with your friends? Can you afford to lose their money? I mean, the answer is obvious, no. And yet that's what our ecosystem does. And so that squashes innovation. Venture capital is needed. And not just a few. Again, use the Silicon Valley example. The best founders are chased. There is competition from the investors, which then means there's a really broad base of investment. And that's what's needed when you have such a high failure rate. The reason it works is the successes are massive. So if we're able to solve really meaningful problems and all of the network and the learnings that come from that help us put these things together, we need it here. We need to stop exporting our innovators like we export our others.
Great to be here at Blackswan Summit. Great to be back at UW. So I graduated from there in the late 90s. I can guarantee that the supervisors did not have a 360 degree proceedings. Quick, just before I answer that question, let me just give a background. Half my life here in Perth, half my life in Asia. Within that half in Asia, half in Hong Kong, doing IPOs for Chinese companies, and half co-founding a VC and growth focused firm called OpenSpace. We've raised over $1 billion of capital. We've deployed in over 80 companies, and thank you for mentioning. We do have some big successes on the ledger, and also quite a few failures, to Brad's point. And that's really what I would love to talk a little bit about today, right? I'll answer the question around how to allocate by sectors. But I think our job as VC managers is to convince the big end of capital allocation talent, the LPs, that we can diversify their capital across multiple opportunities, and we can find at least a handful of winners. And we can get a few base hits, and cumulatively, you can make money out of this particular asset class. Don't make the sports club invest. Don't make your family members invest. Invest in a VC fund, potentially using people's super that could actually diversify the risk and create the right opportunities for a long-term return, as well as funding more Fionas, finding more of those people, being able to get 100 ideas, 1,000 ideas, a Cambrian explosion of innovation can only happen if you can allocate the capital. And so I think it's exciting to be here as we start talking about some of these things. The Blackswan Summit has been amazing, but I've been incredibly impressed by the talk about innovation, impressed by the quality of the science that is happening, including in the deep tech side. But I've been unimpressed by the lack of capital allocators in the audience.
Hands up if you're not a capital allocator. You might not want to.
And they said, we'll give you your first check as long as you go out and raise even more capital than that from the outside, and that money effectively comes to Singapore. And we'll let you do your job, diversify, and then we expect, if you're successful, that we'll be able to bring more capital from various sources. But you need that catalyst, you need that stimulus to fund more of the talent that can then allocate to more of the innovation talent on the ground. Let 100 or 1,000 or 10,000 entrepreneurs give it a shot, but do it through a diversified structure that makes sense for the big end of town. Long introduction to answer your question. I think that the VCs need to have their own angle, how they can add value. So Brad has his angle, how he brings things together. People will have different specialties in terms of their sectors. But I believe there's a place here in Western Australia for West Australia focused innovation. If we can just diversify more checks across this particular landscape, it should stay broad. It's the same thing we did when we got up and running in Singapore. We can do everything from ladies e-commerce all the way through to semiconductors. We could do quantum, we can do AI, we can do blockchain related, we've got strategies for all those things. But sometimes we'll make money on the most mundane and basic innovation-driven technology companies, which are focused on big end markets. And so the key is to make sure the industry is self-sustaining, is to make sure that first wave of VCs focus on Western Australia and make money for their investors in whatever form or fashion makes sense for them. And that could mean deep tech, it could also mean less deep tech that makes money at the end of the day.
So that's market first rather than tech first.
I mean, that's from our perspective, there's a role for different sorts of investors.
Yeah, so we're a hedge fund, and in one reason, just in there going, what am I doing on this stage? I'm a hedge fund. So, I mean, our hedge fund essentially compounds Bitcoin on a monthly basis. And it's not this world, but I love technology. And I've arrived here because I love the space of technology, everything to do with digital assets. since 1987. Advanced composites, civil engineering, pharmaceutical that we work with Fiona on in regards to synthetically generated antibiotics. And what we've seen during that period of time, since 1987, is I've seen the West Australian ecosystem not change since 1987. And so to give you an idea how you navigate around this as an entrepreneur, you're ruthlessly focused on success. So therefore you work out where the money is and how you get to it in whatever it happens to be. So in 1987, when we listed a company called Eagle Aircraft, and we designed and developed an advanced composite aeroplane, we faced a change in regulations, and we couldn't find any money in Australia to do it. So we ultimately joint ventured with the Malaysian government, which was a difficult transaction to say the least. And that joint venture saw the creation of Composite Technologies Research Malaysia. And we taught their workforce how to use advanced composites in a novel way. They're now the 5th largest advanced composite manufacturer for Airbus in the world. And they're turning over around $2 billion a year. That was our little company in 1987. So we moved through that, and then we turned around and we created something like QuickStep, which was an advanced composite curing methodology. And we struggled to raise money. So where do you get your venture capital money in Australia? Well, there was only one venture capitalist in Perth, one. And he maxed out his $6 million well before we got to him. I mean, it was Toy Town. And I said, right, well, where do we get this money? We listed on the Australian Securities Exchange, second listing. Well, I've got to tell you, Australia uses the ASX like it's a venture capital fund. And I describe it, it's like getting dressed naked every morning and all of these people watching you. And the reason why is because they want a news update on your development program at the end of the week. Because that'll keep bumping the price up. Because they need the price to keep bumping so the brokers are involved so that you can do your second round of fundraising. That's not how development works or research and development works. It takes time, you make mistakes, things go wrong, you reinvent yourself. And in fact, we did with that company. And in 2009, some very tall fellows in uniform turned around and slapped us on the shoulder and turned around and said, would you be interested in producing the underbelly panels for the Joint Strike Fighter? It was a $900 million transaction, and we're this tiny little company. And of course we said, oh yes, of course. And why did we have that? Because we were the only independently owned advanced composite manufacturing company in Australia, because the other two were Boeing, which was the competition to Lockheed Martin anyway, and they didn't want to use them, and one other group. So in other words, this tiny little company got this enormous contract, and it's now moved from Australia to New South Wales, because New South Wales said they wanted us and they'd pay us a great deal of money to move, so we did. And it employs about 370 people now manufacturing parts also for the C-130 and a whole variety of other things. And then as we keep rolling through, each one of these stories relates to the fact that it takes a long, long time to raise a small amount of money to get your development program up and going. So Fiona and I just exactly, if you want us to get there and do it quickly, give us money. If you want us to just dribble along, we'll survive because we're determined, we're entrepreneurs, we'll make it. So how do we fix that problem? Well, I've sat on the investment committee for the Perth Angels for a number of years, business angels, for a number of years, and I've also actively sat on the panel of the Private Wealth Network, which is a family office environment, so I sort of swap sides of the panel on that. And that gives two perspectives. It gives the perspective of what the startups are trying to achieve here in Western Australia and what the family offices expect when they invest. Family offices don't want to lose money. So they're not really angel investors until they become very sophisticated and large and they've got a small percentage of their portfolio they'll dedicate to it. Otherwise you can generally not consider family offices an investment area. What worked best in the 37 years that I was involved with startups was tax concessions. It was just like the champagne flowed. And all of a sudden, if you had a tax concession where large organisations could argue the proposition that what you were doing was synergistic in their world, then they would get a 200% tax deduction on engagement, and they'll get a very small tax amount on the success of the business. It became